Well, good morning, Southern Oregon. Welcome back to the Real Estate Show. We have Giles coming into the studio today to talk to us about what's been happening in the last 30 days with the financial markets, the Southern Oregon buyer market, and also ongoing predictions for 2024. Giles, Mutual Mortgage, comes on the show once a month to update us on what is going on with all the money matter part of the housing market. Before we talk to Guy, let's do a quick check for the last week of 2023, our local statistics. Let's start with Klamath County this week. Klamath County prices year over year in the residential market were up 13%. Average single family home now costing $382,136. The number of solds year over year this week were up 175%. That's because in 2022 it was really slow. But in Klamath County, there were 11 closings in the residential market this week. The listings in Klamath County were down year over year 6%. There were 211 active SOMLS listings in Klamath County. Josephine County prices year over year were down 13% this week for residential properties. The average costing now $385,938. The number of solds were down week over week 46%. Again, that's because it was really slow. This week, last year, we had 8 closings in Josephine County in the residential market this week. The number of listings in Josephine County were down 7% year over year. There were 275 active listings on SOMLS this week. Jackson County was up 2% in the price department year over year. The average single family home now costing $513,333. The number of solds year over year were down 58%. That leaves us with 15 residential closings in Jackson County this week. And the number of listings year over year in Jackson County were down 5%. We had 594 active listings on SOMLS this week in the residential market. Now, why do all these numbers matter, and why are some of them double and triple digit? Well, in the price department, we are trying to stabilize. We've been talking about that for months. So Klamath being up this week, Josephine being down, and Jackson being up, that's just another indication of a settling market. The number of solds are doing better this time this year than last year. And the prices and the listings are tied together because we just don't have enough inventory in many of our price points. So again, I sound like a broken record. If you're thinking of selling anytime in the next 2 years, then please consider doing it now because you won't have as much competition. The supply is still really low, but also we understand that not everybody can be ready before spring. So just some food for thought. So now let's welcome Guy Giles of Mutual Mortgage into the studio so he can tell us what's been going on the last 30 days. Well, Guy Giles, we're so happy to have you back in the studio today here at the ACE Radio 1300 AM, our new home. How are you? Happy New Year.
Oh, you too. I'm good. Just getting ready for a year that's going to be busier than last year for sure. Anyway, glad to almost be done with that as far as just the volatility on the rate sides and everything. And
and just the not knowing.
No, that's true. At least they'll have a course of action going into an election year, and at least a coherent one that'll have to stick to until at least November. So maybe we got about 11 months to get some stuff done, and then we'll get all shook up again.
So in a weird way, that gives us a little bit of predictability. Or is that what you're saying?
Yeah, and even though I really felt like the Fed was kind of late to the game as far as getting something done. they did finally, and they were aggressive enough to get it to move. Now everybody's kind of looking at indicators that are a little bit more, I guess, a little more real than what they were looking at before. Everybody was only focused on job numbers, a lot of new part-time jobs, but they still counted those as regular jobs. And when all the dust settled, I don't know. I guess they just tried to make everything look a little stronger than it actually was. Now that we've kind of come full circle, the rate hikes have done what they needed to do, cooled everything off.
Mm-hmm.
Everybody's off of the COVID fix as far as the infusions of money that everybody was doing. Maybe we can get back to something that's a little bit more normal. It's been probably painful for a lot of people to have, if you had to buy a car, or if you had to, maybe use some credit cards to get through, you know, there will be relief coming, probably as soon as March with the Fed lowering rates. Nobody knows exactly when, but it's going to be happening soon. So that'll help with your day-to-day stuff. And again, it doesn't directly affect your mortgage rate, but inflation does. And as inflation comes down, we're seeing that in our rates also.
Mm-hmm. So for 2024 predictions, because we love doing that in January, in the event of some interest rate reductions, what are the guidelines? What do you advise for people who purchased a home during the higher interest rate times? What's the procedure?
I'm going to, well, I don't like just rules, as far as if it goes down a half a point, it's a good time for you. Because if
Okay.
it went down a half a point and you got your loan 15 years ago, it's gonna, the guy from Rocket Mortgage that called you and said, I'm gonna save you $600 a month. You really want to keep in mind that you're starting that amortization over again. So
Gotcha.
everything's on a case by case basis, but to answer your questions, maybe somebody that bought in November or something, when rates were 8% or over 8%. I really think by the middle of the year, more towards the end of the year, our rates should, I would think be in the fives at that point. So
Wow, really?
yeah, and I mean I can't say anything for sure, but we've come down from the eights to the sixes already.
Mm-hmm.
So it's
That's true.
happening, and it's happening quick. And I'm thinking from, I was trying to think from more of a long-term thing. If I was somebody working, in capital markets, putting together the numbers, putting together what the rates are, I would want to be opting for as low as you can get going into all this, because no company wants to bleed off mortgages, meaning that we do a loan and then 3 months later they're getting, solicited by every company in the world telling them they need to refinance to a lower rate.
Mm-hmm.
So, if you don't have those on your books for at least 6 months, then you're literally penalized for it. So I'm thinking that people are going to just be pricing a little bit more aggressively, hoping that somebody's not going to go refi in the next couple of months, or they're going
Mm-hmm.
to have to figure out some way to capture the money from that. And we've been seeing that lately with what we call a par rate, where if you buy a house in the old days, going into this with rates going down and knowing that there'll be a lot of refinances going on, I'd really try everything I can do not to charge points. And by points, you could take that, throw it out the window, put the word percent in there. If you're paying
Mm-hmm.
1% of your loan amount. So it takes a while to recover that. So if we can get them into whatever loan, even if it's a little bit of a higher rate for a while without paying too much to close your loan, I think it makes more sense, in light of the fact that there will be a lot of refinances, I believe, going on by the middle and the end of the year. So what I'm telling people right now is I would say wait a little bit longer. Let's try to find some sort of a bottom on this, because right now it's on the way down, and it's difficult to try to time a bottom.
Right.
But we see from what the Fed is saying, they're talking about, doing their rates, lowering the rates, just an overall cooling of inflation. So we're definitely not to the bottom of anything yet. So people haven't really been contacting me yet that I talked to last year. But I think as the new year comes around, they're going to be looking at credit cards that they racked up, different things like that, talking about doing, refinances. So, I think holding out a little bit longer is probably going to serve people.
Excellent. Excellent. So just watch it maybe quarter by quarter
Yeah, or just
and
stay in
get your
touch with
ducks in a
people.
row. Would it help if people reached out to you ahead of time so
I think
that
so. I have you on the radio. You can see it on on the YouTube part, but on I have a book right here, and literally it's everybody, and it's going all electronic now. Well, that's where I started the book, but I'm watching people, and when it does make sense, I'll be contacting them, and I have a whole lot of people on that list. So
so are you keeping track of the rates that people got when they did their purchase? And then when the rates go down, you know who to call in what order? Is that what you're saying?
yes, yeah,
Nice.
yeah.
Very good.
So, we'll hopefully help a lot of people. And it wasn't a bad thing. If you're thinking, well, I got a rate and it's not the exact rate that I wanted when I bought last year. House prices really didn't go down when the whole thing was said and done. And you were able
Not
to
very
get,
much.
yeah, well, and you're able to get into a house without bidding 30, 40,000 over. I know we've gone over that a few times, but it's still, I think we're right in that in between time right now where it's probably a good time to think about it.
Yeah, well, and we knew it
Back.
was coming. We just didn't know when. So,
Yeah.
so
So
folks, we're talking to Guy Giles, Mutual Mortgage, one of our sponsors. Thank you so much for being a part of the show all these years, Guy. We really appreciate you. We're going to take a quick break and have a word from our other sponsors. We're also brought to you by John L. Scott, Ashland and Medford, our local Rogue Valley Association of Realtors. They have one of the best data websites on housing anywhere. So stay tuned. We'll be right back with more Guy Giles of Mutual Mortgage. Well, hey, Southern Oregon, welcome back to the Real Estate Show. We're chatting with Guy Giles today of Mutual Mortgage. Welcome back, Guy.
hey, thank you. You said one thing before the break about all the years. I honestly don't know how long we've been doing this thing.
Long
Um,
time.
it's been a while.
It's been a
We've
while. Yep.
gone through a few, gone through a few different markets for sure.
Oh, and during the break, I was thinking the volatility was so extreme. We went from this hyper seller market, right, in
Mm.
COVID, coming out of COVID. Well, actually, before that, we had the hyper accelerated coming out of the crash. I mean, you can backtrack these dominoes a
Yeah.
lot of years back, but recently, like the last 3 years, it almost feels like market whiplash because we went way up really, really fast. And then the Fed started doing all these interest rate increases in just like less than 2 years, and everything just slowed way down.
Yeah, and eventually they get it right usually, but sometimes they're again a little slow on the draw, like I said earlier. I mean, it would have been nice if they would have jumped on this a little bit sooner, but at least we're here now and we made it through.
Yeah, but that's what it feels like. It feels like the market just like is taking a breath and trying to rest from making
Right,
it.
and when you say it switches from seller's market to buyer's market, even though we haven't seen, a reduction or a big reduction in the houses, I'm definitely seeing sellers a lot more willing to work with my buyers.
Yeah, and that
So
wasn't the case before.
no, not at all. And it's nice. We're seeing some closing costs paid for. We're seeing some just a whole lot of you know, different avenues to help out the buyers. And that's what was really needed. I mean, I'm a home owner, so I have a dog in the fight both ways, whether you're buying or selling. But when the dust all settles, I love to get my people in a good deal to where, you just feel good about it at the signing.
Well,
So
and a lot of times people have a house to sell, and in a hyper accelerated market, the other sellers are not very they're not very accommodating of that. And it's been nice to watch this last, I don't know, 14 months or so. The sellers not only helping with closing costs, but also accommodating some of the people that had a house to sell.
yeah, and sometimes I'll go back on the county and see what they paid for the house. And even though you feel like, oh, maybe they're giving up a little bit more than you've seen lately, they're still doing all right because housing has gone up.
Well, and
And
isn't that a Southern Oregon thing that the housing always goes up?
it sure feels like it. I mean, maybe 2010 was a little weird, but as far
Well,
as that
yeah.
goes, but other than that, you're right. every time you wait for a little bit of a breather, you might get a little bit of a breather, but you're not getting, reductions. People are still going to come here. The money's still coming in from out of town. It'd be
Yeah, I
nice.
was going to ask you about that. How do you have a sense yet of 2023? How many of your clients were from out of the area and how much were local?
Well, it's funny. Lately, I've been doing a lot more local people than than I have been. But as far as for an overall year, um, I'd say it's a good mix of probably half and half. I mean, first time
Mm-hmm.
home buyers is what I'm dealing with. My pipeline right now probably is 2/3 first time home buyers.
That's
And
awesome.
it is. And those are my absolute favorite ones. I was out taking a couple of pictures of a house in Grants Pass for a deck attached to a manufactured house yesterday. And I'd rode over there with one of my guys that was closing, that he's got 27 houses. So he's, been down that road a few times. But he commented to me when we got back in his car that how excited I was for these people buying their first house. They're 62 years old, buying their first house, just
Oh my gosh.
hardworking people, and they're just excited. And that's actually what gets me up in the morning is those. But but definitely there's a lot more of the first time home buyer fun conversations I've been having lately.
Well, and I think that's a really poignant moment when we start having the first time home buyers coming back. That's an interesting data point because it means that the market has more hopefulness in
Yeah.
it. And it also has the ability for these first time people to qualify. So you need both at the same time. And I think that gets overlooked in these moments in the market because the market is doing better than I think we realize, but it's still a weird market. We all acknowledge that.
No, 100%. I think one of the coolest things I got this last week was a guy that got out of dental school, and he and his wife just sent me a picture of the Christmas tree, and they're like, "This is in our house."
Oh,
And I think I'm going to frame it and put it up with all the pictures in my office of all my closings, just because it is pretty cool when you're doing it in your own house, whether it's a
yeah. And it's hard to
home.
explain to people what that feels like
Well, of
until they know themselves.
Yeah, I mean, and just all of that. Sure, you might have to take care of a little bit of the maintenance and things, but the only thing that sucks worse, I've said this before, than mowing the lawn is mowing someone else's lawn.
Yeah, for
So
year
what
after
happens?
year after year. So I want to talk about FHA and conventional because we were talking about that as we're waiting to go on the air. And I don't know that people really understand the differences. And there is something of a sacrifice with an FHA
Yes.
mortgage, but sometimes that's what you need.
Yeah. So I guess a little bit of history on that is after, and when I say crash, I'm talking, after 2009, that whole thing.
Mhm.
The FHA came out and said that they weren't really solvent, that they needed money in their coffers. So they made a big change to it that neither of us like. Mortgage insurance is something you pay when you have less than 20% down. And it doesn't matter if you put 90% down on an FHA loan, you're going to have mortgage insurance on the thing. And it just,
Forever.
yeah, with a big enough down payment, it will go away. But 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 really, that's kind of forever. So the only time that I'm really thinking about FHA for people, my heart is always to get you into, the right loan that you're going to be in for a long, long time. But FHA seems to fit in if you have a lower credit score and not a huge down payment. I had some people come in. We just actually closed them last week. So a couple of kids, first time home buyers, and they had 3 to 5% down. They needed to do a couple of things to the house, so they wanted to opt closer to the 3% down. And we ended up doing an FHA loan because even though they had good credit, the mortgage insurance with only 3% down, which 3% down, there is a conventional loan that you can do with that. But the mortgage insurance is more expensive. So it just made more sense to put them in an FHA, saving them a whole lot on the mortgage insurance. So and the rates are typically a half a point to 3/4 lower on an FHA loan than they are on a conventional loan. So putting everything together, that put them in while he's finishing his journeyman, to become an electrician. And we know that there's some higher income coming down the road, and they could absolutely afford this. But I've always been a proponent of getting in the game, even if it's, what do you guys say? Get married to the house, not the mortgage.
Right, right.
And I, I don't, I don't like little cliches at all, but that one does make sense in this instance when we know that rates are going down and have been and will for the foreseeable future.
Well, and it helps explain it in one phrase. People get it. They said, oh, okay, so interest rates are going to change over time. The price of the house isn't. Once I'm locked in, I'm locked in. So the people that were bold enough to buy and sell during this last market cycle, I think they really did surprisingly well, don't you?
I think so. I mean, like we've talked about before, there's such a big swing, and in the one example that I did the math on, it was almost 9 years to pay back what you would pay in, well, I say that, I guess not a good way to articulate it, but overpaying for a house. So say that house was for sale for $400,000, and then you're in a bidding war when rates were lower.
Oh, gotcha.
And now you're going $35,000 over, and just hoping that you get the house. And with a 1% difference in rate, it was like 9.1 years to pay that $35,000 back.
Wow, that's interesting.
Yeah, I mean, and that's hard to compare when you're talking 8% compared to 2.6%, what I was giving people, at the low. There's a different spread in that, but I think right now, being kind of in between, it even makes more sense to. I haven't had anybody go in and go over in a little while as far as going over the purchase price.
No, we don't even have that many full price offers anymore.
Yeah, so if you look year over year, I don't think that the housing prices have really necessarily come down, at least as the whole country, goes. But that said, they're definitely not going up as fast, and people are getting into deals that are, I guess, just not bidding over. So I don't know. You could probably speak to what they're worth, and I know we're kind of coming up on a break here, but
Yeah. So I think we're going to have to wait for the final numbers to come out from MLS, but I think they're probably, I'm going to guess, 5 to 10% price drop, but it started recovering before the end of the year. So we are going to take a quick break. We're going to be right back talking to Guy Giles of Mutual Mortgage. Well, hey, everybody. We're talking to Guy Giles of Mutual Mortgage. And right before the break, we were talking about FHA versus conventional and some of the pricing trauma, I guess we'll call it, that we saw over the last year. And it really wasn't, the prices didn't go down as much as we were expecting. You remember this time last year, we were really bracing ourselves for some economic havoc. Not that we didn't have a really bizarre year in that department, but our prices didn't go down as much as we thought, and we still have a shortage.
Yeah, I think it's going to take years to dig out of that hole.
Yeah.
As far as the construction goes. And actually driving into work this morning, I did see the elk down there off of Vilas Road. So hopefully they don't build everything too fast, because it's still nice to be able to see some of the wildlife around.
Isn't that amazing that we have herds of elk so close?
Well, and they came back. I remember, I don't know how many years ago it was, 15 or 20 years ago, they hauled a bunch of them to Idaho just to get them out of here because there were so many of them. And now the last 3 years, they're back. I've seen as many as about 95 of them out there off of 140, just really close to town. And it's still a cool place to live, because there's a lot of people that have still never probably seen an elk, believe it or not. And
Yep. And it's fun to use that as part of marketing Southern Oregon in general.
yes.
Yeah. You don't
A
have
moose
to go
or two
very
would be
far.
cool, I have to admit, but
A
you
moose.
can't have a moose, but
Nah.
everything.
Yeah. But going back to the FHA and conventional, so we were talking about some of the pros and cons of each program. And A
Well,
lot of people don't understand that the FHA is more forgiving. Is that kind of what you were saying? More forgiving on the
they're they're more
credit
forgiving.
score?
Yeah, on the credit score, maybe some history that you've had that's less than perfect as far as that goes. And with the higher LTVs, or what we call loan to values, sometimes we just have to look. They've reduced that mortgage insurance from 80 basis points down to 50 basis points. So that would equate from like $800 a month down, or a year down to 500. So I mean it is kind of substantial as far as the FHA goes. And I'd have to do some math. And if I tried to break away to do that right now, I'd probably be really incoherent in my try to stay off that. But they have lowered the mortgage insurance a few months ago. I'm really hoping they go back to what they did pre the big crash, to where they don't make it, forever, because it's not right. I mean, you're going to have to refinance to get out of that thing, to get out of your mortgage insurance, even if
Well, see, and that's a touchy thing, because first of all, how do you know what the economic conditions are going to be and what the interest rates are going to be when you feel quote unquote ready? And
yes,
then how do you know that your life is going to still be strong enough that you can qualify for that? Now, most people
no,
can, because over time they make more money and, you
no,
know, blah, blah, blah. But I don't know. It is a
that's
roll of the dice.
well, that's what I like about you, is that you go in and you think about these kinds of things. There's a lot of people that don't. They don't think about what repercussions could be down the road. But I know you're always interested in helping people build wealth for their family. And you're right. What happens if, something happened and you had to rack up some credit cards? Now all of a sudden your credit card companies are lowering some of your limits because they're afraid that you're going to get too high. Then that hurts your credit
Oh,
score
see, they've started doing
more.
that. Yeah.
Yeah, so I mean, if you had a $10,000 limit on your card and you owed $1,000 on it, well, that looks pretty good to the credit card company. But if you start and you have 90% of your available credit ready, or available, so say you only take that to 2,000 or 3,000, you're still only at maybe 30% of your credit availability. But now all of a sudden the credit card companies start thinking, wow, we could get in trouble with this person. So maybe they lower your credit limit down from 10,000 to 5,000.
And they didn't used to do
80.
that.
What's that?
They didn't used to do that.
No, but they're pretty.
I'm not saying it's not a bad thing, but I'm just saying
No,
it's kind of a new thing.
yeah. So I mean, it's something just to watch out for, and in my business, everybody's saying, oh, come refinance, then pull cash out of your house and pay that off. But if you can just get rid of that credit card debt, it'll be a little bit easier to do as the Fed lowers rates. Just try to do that as you can. But
Yeah, but I also think that that's why it's good to have a local lender, and somebody like you is going to take the time, we were talking about repercussions, to look at that, the consequences of any decision or direction that the buyer is going to go in, or the refinance person, so that they understand down the road and they don't look back 10 years and go, why didn't somebody see? That's a common complaint from people buying and selling real estate, is why didn't somebody just tell me blah, 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 and then I could have made my own decision.
oh, 100%, 100%. I mean, it's pretty crazy the stuff I see, especially from online lenders. I had a guy send me one the other day saying he was at 6.1% with 0 points, 0%, paying for it. And I'd already looked at the guy's financial stuff, and he's not going to be eligible for a loan until he files his taxes.
Oh,
And
right. That's
and
basic.
yeah, and these guys literally issued a pre-qualification letter. Thankfully,
Oh
I knew the
no.
real estate agent well. And so it said at the bottom, the very, very bottom, oh, this is all dependent on us documenting and verifying your income. How do you give somebody with a 630 credit score a 6% rate? I mean, there was nothing real about this. I got on their website and even looked at their published rates, and at an 800 credit score, they weren't at the rate that they were promising this guy with zero documentation. But the poor guy bought a
Wow.
car through them years ago and thought, hey, it's going to be okay. They did an okay job on my car loan. Well, they probably weren't really documenting anything on your car loan.
Well,
Yeah,
yeah, car loans are way different.
100%. And
Yeah.
but he still had that stuck in his head. that was a good place to go for this. And well, he's not in a house now, but we'll have him in March or so when his taxes are done. But just having somebody that you're right, willing to sit down and talk about, the best way to approach this thing.
Well, and be honest with the buyers.
Yeah, because I mean, he had a pre-approval letter in his hand, a pre-qualification letter.
So his mindset was, I'm good to go. I did what I needed to do. Here's my documentation. Let's go buy a house. And he couldn't. That's heartbreaking.
Thankfully he liked me enough that he came back and showed me what that was. And that's when I was just like, dude, be careful. Don't, go ahead and go send him your tax returns that you haven't actually done. And, this could have been him after he paid for an appraisal, after he paid for a home inspection,
after he tied up somebody's house off market. A seller's house would have been off market for 2 or 3 weeks.
100%. And it would have come back, it would have come back. There's no way that loan closes. And there are loans for those situations. If we have bank statement loans, we have different things, but I'm telling the guy, wait 3 months, 2 months, get your taxes done. And I know you don't know what financial situation you'll be in, but going from $80,000 income to $300,000 income is going to help his purchase power substantially. And not doing one of those funny loans is going to get him a way better rate.
Yeah, well, and 3 months is not that long in house time.
And if he gets
3
his
years
taxes
feels
done,
long, but 3 months is not that bad.
Yeah, so I guess that was maybe a little bit of a rabbit trail, but really it is good. I think the idea is it's good to come in and sit down with somebody that is vested in the community, invested, has a responsibility to do a good job for people. Otherwise, I'd have to go do something for.
But also has enough experience that you can predict the future, so to speak, in a lender way.
We do the best we can. Every now and then you get a crackhead at the helm, and we don't, we don't know what's coming.
Yeah, but to have somebody who could say, we could do an FHA loan for you, and you can buy a house right now with a lower score, and you got higher debt to income. But here's what it's going to be like in 10 years when you're more solvent. You're going to either have to sell that house, or you're going to have to refinance.
Yeah. And a lot of times it's just a matter of talking it through with them. I mean, because
and let them decide.
A lot of times people will just default to the FHA loan. In the meantime, mom has, money sitting in a bank gaining absolutely nothing. And they'd love to bless their kids with 2% down to get them 5%, to get them a little bit better mortgage insurance. And then they're in a better loan for the long term. So, but just there's no cookie cutter thing like happens with the online thing where you just plug in your info and then they spit something out. There's not somebody critical.
Well, I think we need to be on more of an educational point here over time to remind people that it's not cut and dried.
Yeah. And I can compete with those guys too. On rates 9 times out of 10. So, come local, I guess.
Yeah. Well, we've got way more to talk about. Guy Giles, Mutual Mortgage. Going to take a quick break. And then when we come back, let's talk about elders helping their kids or family members. Okay. We'll be right back. Don't go away. Well, Southern Oregon, we've got one segment left with Guy Giles Mutual Mortgage. Just a reminder that this episode will repeat tomorrow, Sunday at 8 a.m. You can listen to it again, Guy Giles and all his good ideas, on our new home, the Ace Radio AM 1300. Super excited to be here. Thank you to Joe Brett and Pete Belcastro for making this all happen. So getting back to Guy Giles, we were talking about some possibilities of other more financially seasoned people helping first-time buyers, second-time buyers have more choices in their loan programs.
Yeah, we're definitely seeing, gift funds from family members, maybe to just kind of put you over the edge. Because what it boils down to is if you have 3% down, you have a certain rate, and then you have, mortgage insurance, and all of those things are based on risk. So if you have 50% down on a house, that's a lot less risk than
To the
3%
lender.
house. Yes. Or, like in this instance, a mortgage insurance company also.
Mm-hmm.
So if you can maybe come up with that 2%, a lot of times you've just heard that you can do a 3% down loan. And so that's just doesn't mean you don't have 5% or couldn't get 5%. It just means that's stuck in your head. But a lot of times, you'll get on the Zillow or get on some of these online places and you'll see that your payment is $2,100, but you're not really factoring in that they were completely wrong on how much the taxes were on the house. They're figuring a 780 FICO score. They're considering 20 or 25% down. So you really have to look at what are called the assumptions when you're looking at these things. But to get back to the down payment, just that extra 2% could save you $100, $130 a month, 150, just depending on the purchase price, credit scores, things like that. So it's always good to have that conversation and let us present to you more than one idea.
Exactly.
So
Yeah. Choices. Just have
yeah,
choices.
I mean the best of both the worlds is to do a VA loan if you're a veteran or your spouse is a veteran. That's no mortgage insurance and you still get the good rate, but you have to be careful of that one also because if you don't have any service connected disability, there's a funding fee that comes with it. So there's all these different dynamics with FHA, VA. I've had people with a really big down payment actually just stick with a conventional loan rather than because they didn't have any service connected disability. So it's just, if you walk in and tell your lender, this is the kind of loan that I want to do, you really want one that's going to look at the whole picture. And
It's so individual. And I think that's got to be one of our big soapboxes this year, Guy, is for people to understand that your lender has to vet you as an individual. You can't just go online and snap something off and know that it's going to be right. Because as you were talking about in the last session, that person was given a pre-approval letter and they thought they could buy a house.
and the guy is an educated guy, but you just read the top and like I
Well,
said,
they don't know because they've never done it before a lot of times.
right. And the guy is great with horses, but finance isn't what he does
Well,
for a living.
and
So,
horses are individual too, so the
oh my
same
gosh.
goes.
Yeah, we shouldn't even go down that road. I got to get rid of a couple of mine. But I mean, especially with guys like that. I mean, a friend of mine used to always say, "What the big print giveth, the little print taketh away."
Oh, that's funny. We should put that on a t-shirt.
I know it is.
That's
It is
funny.
absolutely true.
Mhm.
I've gotten freaked out because I've seen some kind of a crazy rate, and then you realize that it was 30% down, 780 credit score, and it's not apples to apples with what that person's dealing with. They just drove by
Mhm.
that bank and saw that rate.
Mhm.
So anyway, like I said, I'm happy to compete against anybody.
So I got two more questions. I have two more questions. One is just to finish up, having another person help you with your down payment or being a partner. How does that work logistically? Like if you have a family member, like you're talking about this older mom person who is
Mhm.
gonna give the kids a gift, like logistically, how does the mother give that physically to
Yeah,
the kids buying the house?
it's actually pretty simple as far as that goes. You just have we get a gift letter from the parent saying that it's a gift and it doesn't, there's no
So you
expectation
have to
to be
document the
repaid.
money.
Yeah. But usually they're probably doing a side deal that they'll take care of mom when she's older. So, so she'll get it
But
back,
we're not involved in
but
that.
not at all. But it's kind of funny because Fannie Mae and Freddie Mac, they kind of changed the rules a couple of years back because used to you'd have to show it documented in the donor's bank account for a while, a couple of months, so that you didn't really see where the thing came from. Now, if you wire the money, and this has been going on for a while, by the way, if you wire the money directly to the title company, the gift letter is sufficient. You're not going in because sometimes parents are a little bit reluctant. It's like they don't want their kids or anybody to necessarily see all of their financials. So we're not collecting bank statements, for that. We're just getting the gift letter and then that money's getting sent straight in.
So it
So
does not go to the kids.
No, it doesn't.
It goes right to escrow. I bet a lot of parents are more apt to go along with that program then.
Yeah, and I don't see a ton of secrecy, but every now and then, I do see somebody that's just does not want to do that. And this was I don't know if this was a provision that Fannie and Freddie made to just do more deals because they thought they were losing deals on waiting, 2 months for that money to season. But it
Oh,
is,
right, because that's what we used to do.
yes, yeah. So it is a way to actually get the deal done right now. And I think it's almost like a wink wink from Fannie Mae and Freddie Mac just going,
So in that scenario, the older parents that are gifting the extra money, they're not on title and they're not on the loan, correct?
correct. Now, I mean, there are other ways to help where you can be what's called a non-owner occupying co-borrower, where you can, help co-sign for your kids if they're not making, enough money to qualify on their own. And just be careful with that sort of thing. I mean, we do it from time to time, but there's a reason if you don't qualify on your own, so if something happened to mom or dad that did that, you might end up down the road. Just like you said, you can't really tell what the future will bring. Make sure that you can make those payments if you had to.
Okay, and then if you have a parent who co-signs, this is different from just gifting
Yes,
more
yeah,
money. But
yeah.
if you, so does that tie up the parents? How does that tie up the
It will,
parents' credit?
they would be on the loan with the kid. Now that said, after a time, if the kid is making the payment every time, we can document that and not have to hit the parent if the parent goes to buy another house. But
Oh,
that's
really?
probably a little bit of a longer story for another segment. So I could
Okay.
actually prepare that for next time.
Okay.
Or we're gonna end up right at the end sounding like a car commercial trying to fit everything in.
And then I wanted to loop back. We started early on in our episode today talking about manufactured home on land. I think a lot of people don't understand that in Southern Oregon, that can actually be a really good solution.
Yes.
But there are rules about what you can and can't do to the house. Can we just address that in the last couple of minutes?
Yeah, in the late 70s, they did what they called detitled them because basically before that they were just like a car, or what they called chattel. It was just not necessarily attached to the house. And once they detitled them, you're able to buy them as real property as a house. You just have to be careful because structurally you don't really want to mess with the integrity of the house. So if somebody's bolting on porches or having the roof support a big deck, going out, those just things you have to be careful of because they're a little trickier on the FHA loans where they want engineer certifications on every one of those things. But Fannie Mae and Freddie Mac also do have guidelines in there that if it potentially affected the structure of the place, they want to make sure really the standard is that you could drive that thing away from that deck.
So nothing attached.
Yeah, and it would still be standing where it could kind of support itself. And I think we can get around one that I'm actually dealing with right now with, and somebody that's certified by the state to just say, this hasn't really affected the structure of the house. So that's on a little bit of a case by case basis too. And we talked a little while ago about how important it is to have a good lender. It's also really important to have a good agent that can spot those kinds of things like Alice, because if you haven't been around the block a bunch, you could get into trouble with one of these things down the road because we don't necessarily see the house until the appraisal comes in.
Oh, that's
Right.
right. That's right. The lenders are not going out in the field usually.
Yeah. I mean,
Oh.
unless somebody specifically asks me,
But
hey,
also,
can I take a look?
what's nice about you is you do FaceTime and little videos. So like if an agent is out in the field and they're worried in that moment and they have internet, they could reach out to you
Oh, absolutely.
and then
Or
show you. Yeah.
Or in the instance last night, I ran out to Grants Pass. I was with a guy that we were going to a signing for him, but I'm willing to drive out and take a look at something too, because it is a big investment when you look at inspections and appraisals and all of that.
Yeah. And you work in Josephine County
Yeah.
as well as
And
Jackson
doing a
County.
lot in Klamath lately also.
Well, there you go. Our sister to the north, to the northeast. So, Guy Giles, Mutual Mortgage. I'm sorry, we're out of time. Have a great Southern Oregon weekend. Bye now.
Thank you.